Well, it promised to be a blockbuster week for the financial markets last week, and it certainly didn't disappoint, with Fed Chair Powell pushing back twice on the idea of a rate cut as soon as March, the Bank of England making something of a dovish pivot down on Threadneedle Street, the Treasury's quarterly refunding announcement coming in a little bit below expectations, and big tech earnings, including Meta and Amazon, smashing it out of the park, although there was a little bit of a blot on that copybook coming through from Apple. All of that put together allowed equities to rally, with the main three benchmark indices on Wall Street all rising to new record highs on Friday, as the dollar also rose to fresh year-to-date highs amid the hawkish repricing, which was spurred on by Friday's blockbuster US jobs report. This week, it's something of a calm after the storm, as markets continue to digest what's been a rollercoaster last few days, and with a relatively quiet economic docket lined up for the next 4 or 5 trading days. Nevertheless, there's plenty, as always, for myself and Ryan Littlestone to discuss on the Trade Off UK this week. So without further ado, let's crack on with the show. So a busy and volatile week last week, but ultimately a risk-on one, with equities rallying nicely into the close on Friday. Joining me, as always, to try and make sense of what's gone on is Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, a very good afternoon to you, mate. Have you recovered from the volatile nature of the last 4 or 5 days?
Not just yet. Good afternoon. No, not just yet. It's still going. We've had some follow through into Monday, so lots of moves going on. Is this going to be a bit of a game changer, or are we just going to start moving to some new areas? We'll have to wait and see.
Indeed, only time will tell, and I'm sure we'll try and give our steer on that as the show progresses. But it does feel like last week was perhaps the first week that markets really sort of sat up and took notice of what central bankers have been saying for quite some time. And I wonder whether it was a combination of the rhetoric and the strong data that we had last week that really sort of forced the issue on that one, because we've gone from where we were a couple of weeks ago with the market going as a 60-70% chance the Fed kick off their cutting cycle in March, whereas the chances of that now are pretty much stone dead.
Yeah, it's not the first time that the markets have had a wake-up call to this. We had that late last year as well. The market's getting overly dovish and needing central banks to give them a bit of a kick up the arse to say not so fast. And it looks like we're in the same position again.
Exactly that. Very eloquently put. Well, why don't we get on to Topical Thunder and dig into some of those key events last week in a little bit more detail. So I want to kick things off this week with a look at those policy decisions that we just referred to. We've obviously got to start with the FOMC, as expected, keeping the target range for the Fed funds rate unchanged at 5.25% to 5.5%. But there were, I think, 3 interesting, maybe 4 interesting things that I pulled out from the Fed statement and press conference last Wednesday evening. I think the first thing is obviously that pivot that we saw in the policy statement, in the guidance, where they're now saying and referring to, and I quote here, any adjustments to the Fed funds rate rather than any additional policy firming, which was the language that they used back in December, which just is a nod towards the next move, almost certainly being to reduce the Fed funds rate. In a similar vein, they now see the risks to their dual mandate. Recall that is price stability and maximum employment. They see those risks moving into what they call better balance, which again implies that we are getting close to the point where the Fed are able to actually start moving policy to something of a less restrictive setting. But they did push back on the idea that the starting gun will be fired on the easing cycle anytime soon. The statement itself, and Powell at the press conference saying that they need to be more confident that inflation is moving back towards 2% before delivering that cut. And I think that towards is important. They're not saying they want to get to 2% exactly. They're saying they want to get near it and be sure they are going to get there. So they are giving themselves a little bit of leeway with that one. But where Powell didn't give too much leeway was saying that a March cut is not the base case. If the economy were to worsen, if the labour market were to soften, then yes, they can, and they have that optionality to cut then. But it's clearly not the baseline scenario, and I would argue perhaps May is even not the baseline either. So as we alluded to in the intro there, the market pushing back its pricing of the first rate cut. We now see that push back to May. I think when I checked just before coming in to film this, there were around 20 basis points of cuts now priced for the May meeting, which actually still feels a little bit punchy in all honesty. And then after the fun of the Fed, the market moved on to the old lady of Threadneedle Street, the BoE also making a step to a more dovish stance, a three-way split on the MPC as they kept bank rates unchanged at 5.25%. Two policymakers voting for a rate hike, a 25 basis point hike. One, the external member Dingra, voting for a 25 basis point cut. But I think more important than that was the BoE ditched the guidance that they've had in place since all the way back in last August. They've now removed any reference to further tightening from the policy statement and are saying that they're going to keep under review how long they need to hold bank rates at its current level. So a relatively dovish statement from the BoE, but again, in keeping with what we heard from Fed Chair Powell, Governor Bailey at his post-meeting press conference, saying that they're data dependent, not giving a time frame for any cuts, saying that they want to be sure inflation is on its way back to target before they deliver any policy easing. So I guess you could say that those policy decisions were sort of as we expected last week, Ryan, but I think there's plenty of meat on the bones. As you said, rightly, the market is still sort of picking off as we start this week.
Yeah, and we've been speaking about the market, still being overly dovish, the amount of cuts, when they're going to cut. Even moving to May, as you say, is still a bit punchy. There were a couple other lines from the FOMC that stood out, moving from that growth was coming down from high levels to expanding at a solid pace. A bit of a bullish twist on the economy there, that language. But then that was countered also by, even though we got the pushback against the early cuts, we still got lines, that they don't need to see bad data to cut. So that rules out having to see the economy tank before they look to cut. They just want this slow, steady path down to their inflation target. And if that happens, then they can slow and steadily bring rates down behind it. That's the aim of the game. The Bank of England, I think Bailey got lucky, just cut and pasted half of what Powell said. Pretty much repeated the lines, they need to see, be further confident in seeing inflation coming down, removing that line about further tightening. The rate decision, the votes, that was not a surprise at all to see Dingra going for a cut. It was bound to happen at some point, but the same two hawks are sitting in the hike column. So that was pretty neutral. The BoE, as we know, they face a bit of stiffer pressure from inflation. It's not going to come down as quickly as they would hope. We've still got strong wages in the pipe. We're always at risk of seeing an inflation rebound. So the job is definitely not done, and they went to great pains to iterate that as well. And here we are. Really, it's been the dollar that's picked up on all this. Again, as we said at the start, the market finally needing another kick up the seat of its pants to get this early dovish movement, if you like, kicking back further into the year. I still say it's going to be the middle of the year before they start cutting. And I'm beginning to think they're all going to start cutting at the same time, because they'll keep everything nicely in line. But we are data dependent. And when you're getting jobs reports at 353,000, you've got to say, when are they going to cut at all? But it's still all about inflation. But lots to take from it, lots of moves that we've seen since then. And the question is going to be, can these moves continue?
Yes, absolutely. I was going to ask you actually when you thought the first cut was coming. I think we're both still on the same page we were last week, where we're looking at sort of June or maybe even pushing that back into July for when central banks do start to ease. It's interesting you mentioned Andrew Bailey. The chap who owns the coffee shop I was in this morning at the station said to me, Andrew Bailey, he's got to be the worst one we've ever had. And I said to him, I don't think I've ever heard a more spot on comment. Clearly my rants about the BoE over the last 3 years on my way to work have finally convinced him to my way of thinking there. But as you rightly said, inflation is not yet slain. That beast is still there. And I think the general takeaway from last week is, yes, we're going to get cuts. Yes, the next move is going to be lower, but we're probably not going to get them to the magnitude or as early as markets are currently pricing in. And I guess the inflation data that we had last week, particularly from the Eurozone, is perhaps a good example of why that's the case.
Yeah, and inflation's what I want to talk about in my topic here. And looking at the PMIs this morning, well, let's go back to last week. We had that inflation number from the Eurozone. It went the right way for the ECB, but inflation didn't drop as much as expected. The headline CPI came in at 2.8% versus 2.7 expected and 2.9 previously. The core 3.3%, that was expected to come down to 3.2% from a prior 3.4. So moving in the right way, but still remaining sticky. Now, those price pressures may start to pick up once more if the PMIs are to be believed, because we've had all the services PMIs now and the finals from Asia and Europe. And there's one theme among nearly all of them, and that's both higher input and output costs coming into those numbers. The only country where inflationary pressures aren't seen is in the China PMI, where deflationary pressures remain. Now, among those details to do with prices, wage pressures are mentioned in pretty much all of them. And this is a big red flag for central banks battling inflation. So while many CBs, central banks, maintain the line that the job's not done, they will be praying that it is. But if this trend we're seeing in some of the data suggests there's a big risk of those second round effects causing them some trouble, then we're going to know that central banks like the ECB are going to be in a spot of bother. Now, they named tempering wages as one of their triggers to start cutting rates, but no one's really talking about what they'll do if wages keep rising and adding to inflation. At least it will keep central banks in higher for longer mode, but it could bring about more hikes. Now, a lot of economies and monetary policy are walking a fine line between inflation and growth, and central banks are far from out the woods on both. Same could be said about markets, who continue to push this dovish expectations, irrespective of what the data is telling them. We've already had a sizable reprice from those expectations after FOMC and NFP, but I think there's a big risk of markets having to do even more if the data on inflation keeps going the way it is.
Absolutely. I think you are totally spot on there. I think we are not necessarily at risk of complacency, but I do think that, and we've said this a few times on the show now, this last mile of getting inflation back to target. And what we mean there is, the journey we've gone from 9, even 10% inflation here in the UK back down to 3 or 4% has been, I would argue, relatively immaculate. Price pressures have faded out of the economy without too significant a detrimental impact on either the labour market, which we'll get onto in a second, or on the growth side of things. But actually getting from 3 to 4% back to 2%, which is obviously where central banks target inflation to be, I think that is going to be substantially harder. And as you said, there are price pressures bubbling away in those PMI surveys. Certainly earnings are a little bit of a concern. You've got geopolitical issues ongoing in the Middle East and the Red Sea diversions that are taking place. That's obviously going to add further costs. And I think the real worry here is that if you break inflation down into its components, services prices have gone pretty much nowhere for the last 6 months or so. When you look at most major economies, it's goods prices that have fallen off a cliff. And if you're now in an environment where services prices are going to remain relatively sticky at an elevated level, but goods prices are going to start to mean revert and tick higher again, that is then going to start to push your headline inflation rates higher. And that is when central banks have a very, very difficult job, because you're going, particularly in Europe, as you said, the growth side of the economy is pretty grim, to be honest with you. We're calling Germany the sick man of Europe. All of Europe pretty sick, let's be honest. But also, are you then dealing with more price pressures in the pipeline? How do you balance those sort of conflicting aspects? And particularly when the market's trying to bully you into rate cuts as well. Yeah,
very much so. I mean, it's when you look at inflation, it's always a bit of a shock. This period has been a shock. We had a big jump in inflation, up to 10%, and we've had a pretty quick fall out of that inflation highs as well. But underlying in economies, it tends to move much slower. We're still seeing a lot of firms or a lot of industries and sectors having to deal with strikes because people want higher wages just to try and play catch up with price rises from a year ago.
On that. Please don't get me started on that one.
But it's important because that's what central banks worry about. They worry about the second round effects, and you'll hear Lagarde going on about it quite often, because that's when you get the secondary move, the real pressure in inflation, the more domestically led inflation pressure that comes from wages. Because then if people are paying more wages, Firms have to put up prices to cover those wages. So it starts a whole new snowball rolling, and it is a very important one. Now, I'm not saying we're going to see inflation going all the way back up to 6, 7, 8% or not, but it just seeing all this wage pressure coming in, seeing prices rising in the PMIs, it just gets the alarm bells ringing. I think we've got to pay attention to it.
Absolutely. And I tell you what you've brought up there will be music to the ears of Dick Matthews, who is still out there as a lone voice saying that the Fed might hike again and that inflation might make a resurgence like it did back in the 1970s. Mr. Matthews, we love you, really. I tell you what, though, the jobs report that we got out of the US on Friday certainly does give some credence to his case, because it was a huge upside surprise on the non-farm payrolls number, coming in at 353,000 in January. The consensus submitted of the Bloomberg estimates was 185,000. I think the top of the range from memory was about 320. So blasting through all estimates. And of course, you also had added to that a net upward revision to the December and November data of about 126,000 as well. So a really, really strong pace of headline jobs growth. You've got to look really, really far into the weeds and into the details of the report to find anything wrong with it, to be quite honest with you. Unemployment held steady at 3.7%. Participation held steady at 62.5%. Okay, maybe that's a little bit softer than some would like to have seen, but earnings growing at a really sizzling pace, as you alluded to just there, Ryan. Average hourly earnings rising 0.6% on the month. That's the fastest pace since, I think, March of 2022, pushing the annual rate to 4.5%. And I think this just comes back to a point we've made many, many times, which is that all through the tightening cycle over the last, almost 2 years now, it was March 2022 when the Fed first hiked, we've been going, when's the labour market going to roll over? When's the jobs market going to soften? It can't hold up for much longer. Yet we're still sat here talking about an economy that is late cycle, is at full employment, and is adding 300,000 jobs a month. It is quite frankly remarkable. There was really nothing wrong with that jobs report that we got on Friday, a blockbuster report, a Goldilocks report, if you will. And as we said in the intro to the show, it kills the chances of a March cut. Absolutely stone dead, barring some sort of financial accident, which obviously we can't foresee at the moment. And I guess perhaps the bigger question is not, is the jobs market, when the jobs market's going to roll over, it's, is it going to roll over? Is a soft landing now no landing? And Jay Powell has pulled off a quite remarkable feat.
Yeah, and it's all good on the political front as well. In an election year, it's fodder for Biden and staying in power. And that's something we need to keep an eye on as well. But yeah, I mean, we've been talking for over a year. When is the job market going to fall over? And it hasn't. That doesn't mean it can't. That doesn't mean it can't soften. As we spoke about on last week's show, of seeing signs in jobs in general, anecdotal evidence that things are maybe starting to get a bit more negative. But how negative that gets, we just don't know. There's always going to be some sort of normalization within the jobs market. What we have to, I think, look out for is whether we get a soft landing in the jobs market, or whether all of a sudden it just starts falling off a cliff, and we go 2-3 months of seeing negative 200k prints, and then the bubble really does burst. But I think on balance now, it's probably just as much going to see a soft landing in jobs as we are in the economy. And that's all we can be prepared for. And if that's the case, then the US is going to remain top of the pile in the growth race.
Yeah, absolutely. I think that's got to remain the base case at the moment. I wouldn't be. Obviously, we've got another jobs report before the Fed give us their latest forecasts. From memory, I think 2024 unemployment, they see it at 4.1%. Maybe they'll revise that down a tick or two if we get another strong payrolls number. But of course, if the jobs market does remain as resilient as it is at the moment, that's going to underpin consumer sentiment, consumer spending, and that will obviously feed through as the main driver of growth as we move through the remainder of this year. So, certainly all looking relatively positive on that front. But of course, the usual caveats have to apply. It is only one data point. It will be revised. And obviously, we need to see whether that is a trend. But certainly nothing in that January jobs report that screams recession or slowdown or any concern really at all at this point. But anyway, we could talk about that until the cows come home. Ryan could also talk about trading advice until the cows come home as well, actually.
Yeah, I can talk trading tips all day long. It's one of the things I like doing, trying to help out traders navigate these markets. So today I want to talk about break trading. Then a lot of assets, particularly FX, we have a lot of pretty tight ranges going on at the moment, although some of those are breaking down today. In others, we have some solid longer term support and resistance levels. All these are valid to trade, but what a lot of traders miss out on is the opportunity to trade when these levels break down. I think a lot of complacency feeds into trading good levels. They hold a few times and the confidence in them grows and good money is made. However, just because they may fail later on doesn't mean you can't profit from that too. Often when decent levels break, there can be a good follow through. You only have to look at the S&P over the last couple of weeks when it finally broke that 4800, 4820 level. Then it motored on and we're sitting happily in the 4950s. So how do you set up to trade a break? First, you have to look for the right signs. I look to trade breaks when a level has had multiple tests. Cable is one good example where we've had a very tight range and multiple tests in the 126, 128 range. And the longer these levels last, the more likely a break is going to be more volatile. So again, complacency can lead traders to build larger positions, trusting the range, which then increases the stops sitting outside of the range, which then increases the volatility of a break. So how can we trade a break? One good aspect of trading a break is that it can be a fairly low risk strategy. Placing buy or sell stops above or below the range levels, the range edges in play mean that they're only triggered if the range starts to break. That means you can continue trading the range while it works out, but if it finally breaks, you can potentially grab the break move. Now, I usually set my stop entries 10, 25 pips outside of the range edges. And, a stop loss on those may be the same amount back inside of the range edge, which means I can keep my risk relatively low just in case the break is a fake or a quick stop run in reverse. I will also be quick in taking profits if the trade quickly moves, say 10, 20 pips into the green, as I always want to lower my risk as fast as possible. So I want to profit from the initial break move and then assess how the price may continue from there. And from there, one can look at trading the break confirmation by the break level being retested and then holding. So I think traders need to have more than one way to trade, and break trading is just another way of expanding your opportunities.
Very good. I have very little to add to that. That was incredibly comprehensive, mate. What I will say
enough,
is,
so you don't need to.
What I will say, though, is I mentioned cable last week. I think I called it the most boring G10 currency pair out there at the moment. And what do you know, that seems to have put the kibosh on it because we're trading below the 126 handle, I think at our lowest level since mid-December as we record this. So, there we go. Mike Brown jinxes the financial markets once again. Right, in any case, let's get on to having a look at some charts, shall we? Right, let's have a gander at what else I can jinx this week. We're going to start with the euro, which is something we spoke about on last week's show. Recall we were trading around the 108 figure last week. I said we'd probably trade 105 first. My good friend Ryan there said we'd probably trade 111 first. Well, it looks like Michael might be aging just a little bit better so far, but it is obviously still early days. We did have a fourth straight week of losses for the common currency last week, and I think Friday's close was an interesting one because after that dollar demand that came in after the non-farm payrolls print, we actually ended the week below the 108 handle and right on the 100-day moving average, which per this chart here came in at 107.85. And then in early trade today, as this week's got underway, more dollar demand has come in. The pair's been pressured a little bit further. We've actually broken south of that 100-day moving average, which, as you can see on the chart there, we haven't actually closed below since all the way back in November, because that level actually held as very, very strong support during that dip towards the middle of December last year. So I think if we can close here, that's likely to entice a few more bears to come in and enter the market. The 107 figure is the obvious target to the downside. And then below that, I think there's an interesting range between 106 and 106.10. Not only is that, of course, a psychological level, but it's not on the chart here. There is also the 76.4 retracement of the rally that we saw in the fourth quarter of last year. That comes in around 106.15 from memory. So I think that's a more important medium-term level to look at. Personally, I still like this lower. The techs are starting to line up with the fundamental situation, which we've obviously just gone through. I don't really see any reason to be owning the euro at the moment. And unless and until we move back above that one, the 200-day moving average, forgive me, in the mid 108s, then I like this lower for now.
Yeah, definitely seems like the trend is well entrenched now. And I said last week it'd be interesting where we close the week after all the events, and we closed on the lows. We keep making lower lows. It's been doing that all year. So there's no reason to change this at the moment. However, getting in the 107s now, my big level, we've got the 61.8 fib at 107.12.13. That's from the September, October move up. The 107 level is a huge level. You only need to drop the line on your chart and go back over the years, many years, to see how much of a level that is. So that's going to be the big one for me. If we break under there, you may get your 105. But if that's where we seem to run into trouble, perhaps the repricing of the repricing finally gets finished in that 107 zone, then I'm potentially going to be looking to add back into my longs that I took last year down at those 105 end levels. So it's not done yet. I still may get my 111, but it is today looking a bit more shakier than it was last week.
It is, that's for sure. Well, speaking of the repricing of the repricing of the repricing, however many times you said it, I guess the most obvious place where that hawkish repricing is shining through in financial markets is, as always, the Treasury market.
Yeah, and we like to look at this now and again. 10-year yields, they seem to be driving the bus again, particularly for the US dollar. We know we tell you how important it is to keep your eye on yields if you're trading the dollar. And we're seeing 10-year yields developing a bit of a range between sort of 370 and 420%. The 4% level seems to be acting as a sort of hawk-dove pivot level for the market and which way the dollar goes. That's an interesting dynamic for me, because whichever way we break will indicate whether the Fed or the market has changed its stance. So, as mentioned earlier, the market is still generally all about cuts. So if yields start going higher without a change in rhetoric from the Fed, that would indicate that the bond market at least sees less dovishness than other parts of the market. And as we know, where the bond markets go, the rest usually follow. But while we remain in this range in US 10s, I'm not expecting FX pairs to significantly move. We may widen some of these ranges and see others break, particularly more short-term ranges. But if we stay contained here in yields, we'll see FX broadly walk in the same old paths. Of course, if we break this range, then that's where we may see something different and more longer lasting in FX. So a break above 420 would target the next level around about 450, while a break below 370 would put focus on the bigger 325 area. Both the 450 and 325 are, again, big long-term levels, so they need monitoring on your charts, and that will be the defining action for what we see with the dollar.
Yeah, I think this is a really, really important chart, as always. It is pretty much driving the bus in terms of G10FX, as you rightly said, and we will see where things go next. I put out a chart earlier, actually, I think it was in an article I wrote, around overlaying yields and the dollar index, and they have literally been trading tick for tick for 6 months now. So I think this is an absolutely pivotal one for market participants to be keeping a very, very close eye. Right, well, yields were one story from last week. I guess the new record highs that we saw on Wall Street were another. I think everyone will probably know at this point. I'm sounding like a bit of a stuck record, but I've been bullish on the buck and bullish on equities for quite some time now, probably the last 6 months or so. And actually, I see very little reason to change that view. The exceptionalism, Goldilocks, soft landing, no landing, whatever you want to call the macro narrative at this point, it hasn't really changed too much, to be quite honest with you. And I think that should continue to support the dollar, particularly if we see the market start to price out a May rate cut as well, which, as we said earlier, there's still about 20 bips priced in the curve at that point. So the dollar has had 5 straight weeks of gains. I see very little reason why the path of least resistance can't lead us higher into a 6th this week. And then when you look at the equity market, stocks have really managed to shrug off that hawkish repricing and have been massively helped by the tech earnings that we had last week, particularly from Amazon and, more importantly, from Meta, who rallied well over 20% on Friday. And I think the other thing that speaks of real importance to me in the equity space at the moment is the price action on Friday. We had a bit of a dip after the payrolls number, a knee-jerk move lower in the S&P and in the Nasdaq, but that dip was just bought into incredibly rapidly, incredibly aggressively. We closed about 1% higher on both at a new all-time high, and to me that suggests again that the path of least resistance in terms of the equity market continues to point to the upside. And when you look ahead to this week, the economic calendar is, to be honest with you, quite boring. There are really no real big risk events for financial markets until the next US inflation data, which doesn't come out until the 13th of Feb. And I think the overarching thing here is that of all the signs that you can get in the financial markets, of all the indicators you can look at, perhaps the most bullish of all is a market that continues to print new all-time highs. And I see no reason to bet against that continuing, at least over the coming 5 or 6 days.
No, I tend to agree, and it was quite a surprising move that we got on Friday because stocks reacted as you would expect to strong data, where it means that the Fed's going to be higher for longer, and stocks dropped, and so the rebound was quite surprising. We moved back to the range, to the level before the data, and then when I looked at it in the evening, we making fresh highs up in the 70s. It was quite a surprise. Yes, this could continue. There's a big fat target on something like the S&P at 5,000, big psychological level. Might be one of those levels where it's too close that we have to go and tap it, and then maybe that's the top. But for now, the support picture behind stocks, particularly the S&P, is there. It's supporting the break that we spoke about, 4,800, something that I've traded a couple of weeks ago, and it's ongoing. And if this data is going to continue, and that actually means good news for stocks, then pretty much the sky's the limit for this. But I'm loath just to think that in one report the market has changed from dovish Fed equals higher stocks. I don't think we're quite there yet, but we could be on the way.
Yes, I think that was an interesting reaction. It was the first data point we've had in a while where good economic news was good news for the market. And I think if that is the dynamic we're now going to be trading in, then it's a very, very important one to recognize that may have changed. Of course, in 25 minutes from now, while we're recording, this will be well out by the time you watch it. We've got the ISM services data, and we will see whether that continues into the data there as well. Ryan, you've managed to choose something to discuss that isn't particularly volatile, and that is the pair I love to hate, which is Euro sterling.
Yeah, ragging on the euro sterling again, never ending. This one is a bit of a follow-up look we did last week because the battle's been going on still around the 85 level. This one's becoming even more interesting as a lesson in price action patterns and what may happen from here. I've mentioned previously that it doesn't matter what the drivers are behind a currency are sometimes. All that matters is the price action. And the price action at one level is something that can define what the future path is for an asset. And this is happening right here at 85 in euro sterling. We've had 7 days and 7 tests of the 85.20 level and 7 rejections from that. That we've only made a low of 85.13 in that time shows us how strong this support is into the big figure. That's why it's highlighted. That's why it's a very important number. I think this is all about the clock. At the moment, the longer sellers keep hitting the rallies and the buyers keep buying off the low, the bigger the stops will build either side. That means volatility is growing for when we do break. I'm still long from trading this down here last year, but in this situation, I will grow more confident that planning for a potential break lower and thus flip into a short, purely to try and catch that volatility. So even if this isn't a pair for you to trade regularly, it's worth watching to learn about price action patterns that can be used to trade any asset you like.
Indeed, yes. What I'm going to do is have a nap, and then even when we break the 85 figure, I'm going to go back and watch your little segment on trading a range break, and then we might get into a position. But I certainly won't be holding my breath for it. I'll be honest with you on that one. Right.
Terrible. Oh, can't believe it.
It could be worse. It could be worse. Why don't we get on to our plays of the day? Right, I'm going to be brave this week, because the last couple of times I mentioned this, I've managed to get myself in trouble. But we're going to talk about the Kiwi dollar once again this week. And the reason why I'm doing so is because things aren't looking particularly great for the Kiwi at the moment. It is perhaps looking like a bit of a flight this bird. Last week was a fifth straight weekly dollar week. That was awful, wasn't it? It was a fifth straight weekly loss for the Kiwi dollar last week. And Friday saw us close beneath the 200-day moving average for the first time since December. There's a few moving parts here. I think obviously that broad-based dollar demand is one. The fact that the Kiwi can't catch a bid despite risk assets rallying is obviously a concern as well. And then you've got China, which is still the biggest issue here, where sentiment just remains incredibly dour. In terms of a domestic catalyst, we do have the fourth quarter labour market data out this week. We're expecting quite a chunky rise in unemployment when that data prints on Tuesday evening. 4.3% is the consensus, up from 3.9% prior. That would take unemployment to its highest level since the second quarter of 2021. And when the market's not pricing the first 25 basis point rate cut until July, I think the chances of a dovish repricing are relatively high. I think it's a bit optimistic to think the RBNZ can hold rates for that long, particularly with the labour market softening. Growth is rolling over. And of course, the other consideration is that the RBNZ were first to end their hiking cycle back last May. And I think, therefore, we can logically expect they may be one of the first to pull the trigger on a cut as those lagged effects continue to come through. On a technical level, we're below the 50% retracement of the Q4 rally we saw in 2023. If we get a closing break below the 100-day moving average, which comes in at 60.60, then I would be looking to ride this lower and perhaps even down into as that downtrend in green there continues. So that is my play of the day this week. If we get above the 200-day moving average, it's something I would be looking to get out of. Ryan, you're looking at the yellow metal, I believe.
Yeah, looking at the yellow metal. I first want to say I feel sorry for the guys and girls who work in your post room, having to deal with all the hate mail that you're going to get from slagging off the Kiwi every week.
Nice. I didn't say anything.
Negative. It's always negative. We love you over here. We love you over here. Excuse me. So, yeah, gold is my play of the day. Purely a technical play of the day today. It looks like it might want to test support down at 22,000, which has been a pretty solid level. There's still plenty of geopolitical risk in play, so I don't think this has much reason to really drop. So this move that we're seeing today looks like it's pretty much tied to this bout of dollar strength we're seeing. So I'm going to look at longs into 2010, 2000, but I won't be closed-minded to flip into a short if 2000 breaks and we see a confirmation of that break. So longs for me down into support.
Good stuff. Well, that does bring us to the end of another show. Thank you very much, as always, for watching. Thank you, of course, as always, as well, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me, and to our producer, Kyriakos, as well, for bringing this together as brilliantly as always. If you've enjoyed the show, please drop a like on the video. Leave a comment as well. Let us know your thoughts and how you're trading the markets and viewing things at the moment. We will, of course, be back with another episode of The Trade-Off this time next week. I'm off to go and put 50p in the meter to make sure that the lights can stay on for that episode. In the meantime, we will hopefully you trade the markets well this week, and we will see you again in a week's time. Thanks as always for watching, and goodbye for now.